You get the offer letter. Base salary is solid. But then you see the real number, the one that makes your eyes widen. Stock options, RSUs, equity compensation. Total compensation, $400,000. You screenshot it. You send it to your partner. Maybe you post it tastefully, humbly somewhere online. You feel like you've made it. 3 years later, you're at the same company, working harder than ever, and the number in your brokerage account looks nothing like what was promised in that offer letter. Maybe the stock dropped. Maybe the vesting cliff meant you lost everything when you left 6 months early. Maybe the options were underwater, meaning the strike price was higher than the current stock price, making them worth exactly zero. Maybe you stayed at a company you should have left 2 years ago because you were waiting for your equity to vest. Or maybe you got acquired, and the terms of the deal meant your options got wiped out by a liquidation preference you didn't know existed. You're not alone, and you're not stupid. You just weren't told how this actually works. Today, we're going to break down the stock option trap, why equity compensation is almost always worth less than the number on paper, what the fine print actually means, and how to think about it before you make a major career decision based on a number that may not be real. Why equity compensation exists and who IT really benefits. Let's start with the honest version of why companies offer equity, the official story. We want you to be an owner. We want your incentives aligned with the company's success. We want you to share in the upside. The real story is more complicated. Equity compensation lets companies pay less cash. Instead of offering you a market rate salary, they can offer you a below-market salary plus a promise of future value. That promise costs them nothing today. For early-stage startups, this makes sense. They genuinely don't have the cash. The trade-off is real. Lower salary now in exchange for meaningful upside if the company succeeds. But the model has spread far beyond early-stage startups. Large public companies, late-stage private companies, and even companies with plenty of cash now use equity as a core part of compensation, partly because it aligns incentives, but also because vesting schedules create what's known as golden handcuffs. You don't leave, not because you love it there, because leaving means leaving money on the table. That dynamic benefits the company far more than it benefits you. And understanding that is the foundation of thinking clearly about equity. The first layer, what total compensation actually means. When a recruiter quotes you a total compensation number, they're adding together things that are not equivalent. Base salary is cash. It hits your bank account on a schedule. It is certain. Stock options or RSUs are not cash. They are a promise of potential future value, subject to vesting schedules, market performance, tax treatment, liquidity, and a long list of terms you probably haven't read. Adding these two things together and calling it total compensation is a little like adding your annual salary to the value of your house and saying that's what you earn. Technically a number, not particularly useful. The problem is that people make decisions based on total comp as if every component is equally real. They compare offers, negotiate, and calibrate their lifestyle expectations against a number where half or more of the value is uncertain, illiquid, and years away. This is how people end up accepting lower base salaries than they should. The equity feels like it makes up the difference. Sometimes it does, often it doesn't. The first discipline in thinking about equity is to mentally separate the components. What is the guaranteed cash component? What is the speculative component? And are you being compensated adequately for the certainty gap between them? The vesting schedule, the clock you don't control. Most equity compensation comes with a vesting schedule, typically 4 years, with a 1-year cliff. Here's what that means in practice. If you leave the company before your 1-year anniversary, you receive zero equity, nothing. The entire first year is a cliff. You're either fully over it or you're not. After the cliff, equity typically vests monthly or quarterly over the remaining 3 years. So at the end of 4 years, you're fully vested. This structure sounds reasonable until you think about what it actually does. It means the company has, at any given moment, a significant financial incentive for you to stay, not because staying is necessarily good for your career, but because leaving is expensive. You're 9 months in. You've been offered a better opportunity elsewhere, but your cliff is in 3 months, and walking away now means forfeiting a full year of equity. So you stay, maybe 3 more months, maybe longer, because after the cliff, you've started accumulating again and leaving still feels costly. This is the golden handcuff in practice. And the handcuff works regardless of whether staying is actually the right decision for your career, your growth, or your financial future. The research on job mobility is fairly clear. Changing jobs, particularly early in your career, tends to accelerate salary growth faster than staying. But equity vesting schedules create a financial architecture that pushes against mobility. You need to account for this when you evaluate an offer. The vesting schedule isn't just a detail. It's a structure that will shape your decisions for the next 4 years. Make sure you understand what you're agreeing to. The second layer, options are not shares. Here's where a lot of people, including very smart people, get confused. There's a fundamental difference between stock options and RSUs, and within options, there are further distinctions that have major financial consequences. Restricted stock units, RSUs, are relatively straightforward. When they vest, you receive shares. You own something real. The value depends on the stock price, but the shares themselves are yours. Stock options are different. An option is the right to purchase shares at a predetermined price called the strike price or exercise price in the future. So if your options have a strike price of $20 per share, and the stock is currently trading at $25, your options are in the money by $5 per share. They have real value. But if the stock drops to $15, your options are underwater. You have the right to buy shares at $20 that are worth $15. Nobody exercises that option. Your options are worth $0. This happens. It happens at large, established companies. It happens at startups that seemed promising. It happens when markets shift, when industries contract, when management makes bad decisions. And when it happens, the number in your offer letter, the one that made you screenshot and celebrate, means nothing. There's an additional complexity with startup options specifically. Early-stage companies grant what are typically called incentive stock options or non-qualified stock options. The tax treatment of these is significantly different, and the decision about when and whether to exercise has major financial and tax consequences that most people don't fully understand until they're already in the middle of it. The short version: options are not shares, they are a bet. And like any bet, the outcome is uncertain. The liquidity problem. Let's say everything goes well, the company grows, the stock price rises, your options are in the money. Your RSUs have vested. On paper, you have significant value, but you can't access it. This is the liquidity problem, and it's one of the most overlooked dimensions of equity compensation. For public company employees, liquidity is constrained by trading windows and blackout periods. You typically can only sell shares during specific windows, often a few weeks after quarterly earnings releases. Outside those windows, you're restricted. And if you have material non-public information, which employees often do, the restrictions get tighter. For private company employees, the situation is more severe. There is no public market for your shares. You cannot sell them whenever you want. The only ways to realize value are through a liquidity event, an IPO, an acquisition, or a secondary sale, none of which are within your control. Companies can stay private for a decade or more. They can confidentially file for an IPO and then pull it when market conditions change. They can get acquired at terms that prioritize earlier investors over employees. They can simply grow slowly in ways that never create a liquidity event. Meanwhile, the number in your total compensation package looks real. It affects how you think about your net worth. It affects the financial decisions you make. It shapes your sense of security. But it's a number you cannot spend, borrow against in most cases, or convert to cash on your timeline. Paper wealth and real wealth are not the same thing. And equity compensation, particularly in private companies, is almost entirely paper. The liquidation preference problem. Here's a term that almost never appears in employee communications but can make the difference between your equity being worth $1 million or zero. Liquidation preference. When venture capital firms invest in a company, they negotiate terms that protect their capital in an exit scenario. One of the most common is the liquidation preference, a provision that says investors get paid back first, often at a multiple of their investment, before any proceeds flow to common shareholders. Most employees hold common stock or options that convert to common stock. Investors typically hold preferred stock with liquidation preferences. Here's what that means in an acquisition scenario. Company gets acquired for $150 million. Sounds like a success. But investors put in $120 million across multiple rounds, and their liquidation preference is 1.5 times their investment. That means investors receive $180 million before common shareholders see anything. The acquisition price was $150 million. Common shareholders, including employees with vested equity, receive zero. This is not a hypothetical edge case. This happens. It happens more often than the industry acknowledges publicly. And employees, most of whom never read the cap table, never reviewed the preferred stock terms, and never modeled out different exit scenarios, are blindsided by it. If you're joining a startup and equity is a meaningful part of why you're taking the offer, you should ask to see the cap table. You should understand how much preferred capital has been raised, what the liquidation preferences are, and what exit price would be required for common shareholders to receive meaningful value. Most companies will not volunteer this information. Some will share it if you ask directly. Some won't. What they won't share tells you something important. The tax dimension. There's one more layer that consistently surprises people. Taxes. Equity compensation is taxable. But when it's taxed, how it's taxed and how much it's taxed varies significantly based on the type of equity and the decisions you make. RSUs are taxed as ordinary income when they vest. If you receive 10,000 shares that vest when the stock is at $30 per share, the IRS considers that $300,000 of ordinary income in that year. Your tax bill arrives whether or not you sold any shares. This creates a situation where people have a tax liability on equity they haven't converted to cash. If the stock then drops after vesting, you've paid taxes on value that no longer exists. Stock options have different treatment depending on type and timing. Incentive stock options can qualify for capital gains treatment if you hold them long enough, but exercising them can trigger the alternative minimum tax, which is a parallel tax system that catches people completely off guard. For startup employees considering early exercise, buying your options before they vest, which can sometimes reduce future tax liability. The math is complex and depends heavily on the company's trajectory, your personal tax situation, and a set of rules that most people don't fully understand without a tax advisor. The point is not to explain every tax scenario here. The point is that the number in your offer letter is a pre-tax number, and after taxes, the actual economic value to you is substantially lower, potentially by 30 to 50% or more depending on your income level and situation. When you evaluate equity, you need to think in after-tax numbers, and you probably need an accountant to help you model it, particularly if the amounts are significant. The opportunity cost nobody calculates. Beyond the direct financial mechanics, there's a cost that almost nobody accounts for when they accept an equity-heavy compensation package: opportunity cost. Golden handcuffs don't just keep you at one company, they keep you away from others. The job you didn't take because the equity wasn't vested yet. The startup idea you didn't pursue because you were too close to a vesting cliff. The company that would have accelerated your career but couldn't match your unvested equity on paper. Every one of those is a real cost. Not quantifiable in the same way, but real. Vesting schedules create a temporal lock that shapes your career decisions for years at a time. And those decisions compound the same way money does, the same way habits do. The person who moved freely took the right opportunities and optimized for career trajectory rather than vesting schedules may have foregone some paper equity. They also may have compounded their earning power and optionality faster than someone who optimized for staying. This is not a recommendation to ignore equity or job hop without strategy. It's a recommendation to account for what you're giving up when you let vesting schedules make your career decisions for you. How to actually evaluate an equity offer. So what does rigorous equity evaluation actually look like? Step 1. Separate base from equity. Is the base salary competitive on its own? If the equity evaporated tomorrow, would you still take this job? Step 2. Understand the type of equity. Options or RSUs. If options, what's the strike price and how does it compare to the current valuation? What type ISO or NSO? Step 3. Understand the vesting schedule. 1-year cliff, 4-year total is standard. What happens to unvested equity if you're laid off? If the company is acquired? Step 4. For private companies, understand the cap table. How much preferred capital has been raised? What are the liquidation preferences? What exit value would be required for common shareholders to see meaningful returns? Step 5. Model realistic scenarios. Not the optimistic scenario that one doesn't need modeling. The realistic scenario. The down scenario. What does your equity look like if the company exits at 1 times the last valuation? At half, if it doesn't exit for 7 years. Step 6. Calculate the after-tax value. Every number in your offer is pre-tax. Get a real after-tax estimate before you compare. Step 7. Account for opportunity cost. What are you giving up or locking into by accepting this vesting schedule? Most people do none of these steps. They see a large total compensation number and they feel good. That feeling is exactly what the structure of the offer is designed to produce. The larger pattern. The stock option trap isn't really about stock options. It's about the gap between how compensation is presented and how it actually works. It's about a system that is optimized for recruiting for making offers look as large as possible rather than optimized for your financial clarity. Companies are not being dishonest. Everything in the offer letter is technically accurate. The equity is real. The total comp number is the sum of real components. But the framing is not neutral. The presentation is designed, and most employees, including highly educated, analytically capable employees, accept offers without doing the analysis that would give them an accurate picture of what they're actually agreeing to. The result is a workforce of talented people who feel financially compensated but are actually less financially secure than. Their income suggests anchored to jobs by vesting schedules, holding paper wealth they can't access, surprised by tax bills, and blindsided by liquidation preferences they didn't know existed. Closing. The offer letter with the big total comp number. The screenshot, the celebration, the feeling of arrival. Those feelings are not wrong. Getting a competitive offer is worth celebrating. But there's a version of that celebration that's fully informed, that knows what the equity actually means, that has modeled the scenarios, that made a clear-eyed decision rather than an emotionally driven one. That version doesn't feel less good. It actually feels better, because the choice was made with clarity rather than hope. The stock option trap doesn't catch people because they're not smart. It catches them because they're not told how it works. Because the industry has no incentive to make the fine print legible. Because the celebration makes the due diligence feel unnecessary. You now know how it works. The next offer letter you receive your own or someone you know deserves to be read slowly, questioned carefully, evaluated honestly, because the number at the top is not what you're actually being offered. What you're actually being offered is in the details, and the details are where the real decision lives.